Hey guys, Jared Duckett, Duckett Ladd, Dental CPAs and Advisors, back with my business partner, Bill Ladd, and another PPP video, guys. I'm smelling the end. I'm seeing the end of this thing. Bill, do you agree?
I do. I do. We finally have the application for forgiveness, although I have to admit, I think it confused me even more than I was before, Jared. This is 11 page of kind of circular references and everything, but it does have some clarity that we can hit on for sure.
Yeah, it does. And you hit on it. It's 11 pages. Basically, this came out last Friday. Kind of snuck this out, and it's 11 pages. A lot of, I don't know, maybe four pages or so of the forms, 4 or 5, and the rest is instructions. A lot of instructions in here. Go out to the Treasury website and download it and look through it. But what we're going to do today is really not dive deep into everything here. Is we're going to stay fairly high level, but what we want to do is really just hit the highlights of kind of the big things that we see out of this, and then we're going to follow up next week and actually get our hands dirty. We're gonna work up a case study, probably on a dental practice, and we're going to roll through the actual spreadsheet and kind of case study, and that's really going to spur a lot of conversation, I think, on how specifically it'll work, for a business. So let me share my screen real quick. Go ahead.
I will say too, Jared, this will change. I mean, there are some things that we do need clarity on. So what we say now on May 22nd may change, but certainly this is our take based upon our understanding of how we read the document. Treasury will certainly come out and clarify certain things on this in SBA.
So just diving right in, we'll kind of just ping back and forth, Bill, and just create conversation. But kind of this application, loan forgiveness application, provided a lot of clarity on payroll cost and overall just eligible cost. And I know at the beginning when the interim final rule came out, there was some cost paid and cost incurred language, about which cost qualify. And this gave us a little clarity, maybe still some stuff up in the air. But basically it says payroll cost paid and payroll cost incurred during the covered period. And it shed a little light on incurred. So we're talking about payroll here, and incurred is the date that the employee earned that money. Okay. But then you get into the thing of, was it paid and incurred? Or what happens at the end? I know a lot of people were saying, what happens at the end when I've got some payroll incurred and my pay date is going to be outside this covered period? What do I do? Try to squeeze a period in there? So there is some potential here for possibly including payroll incurred prior to the covered period and paid during the covered period. Because if you think about it, that first payroll you're going to probably pay is going to have a portion, because you pay payroll in arrears. So it's going to have a portion that would have been incurred before the period begins. So there's potential, there's maybe a little contradictory language in there, and we're getting detailed here, and slash or, stuff like that. But we're seeing that there might be potential there. And then also on the flip side, and it specifically calls this out. It specifically says that payroll incurred during the period, again, the date it's earned, and paid outside the cover period, but before, in accordance with the regular pay cycle, that is going to be eligible for forgiveness. So that's a whole lot of mouthful about and or incurred, Bill. It kind of sheds a little light on that if you can. I know it gets pretty dicey.
Yeah, I mean, it's funny because on page 2, it says payroll cost paid and payroll cost incurred, which I interpreted to mean kind of or. You kind of interpreted that to mean it had to be both. So it took us actually diving into further in the document, page 7, where then it says payroll cost paid or incurred. So you're right, we do have contradictory language. My gut or my thought is that it's telling us that as long as it is either incurred or paid in the payroll period or covered period, you should be able to include it. And some of the research we've been doing seems to indicate that. But again, that is something that we're hoping that they make that crystal clear, because it is a little bit confusing right now, no doubt. But if it is the or, then yeah, there's a potential to have some payroll cost in there, maybe get that number up a little bit more than we were thinking.
Yeah, no, you're exactly right. There probably will be an FAQ maybe that comes out and clarifies that a little bit. But yeah, a lot of people are reading this too and interpreting it the same way you are, Bill, that it's payroll costs paid or incurred. So we'll kind of make sure we'll follow it up a little more, but we think there is potential for including prior payroll incurred in that eligible cost. And then also kind of on this same topic, they specifically said that there's basically an alternative payroll measurement period. And this measurement period is specifically to payroll costs. So you've got the covered period, right? It's the 8-week period beginning on the date that you receive the PPP loan, the date it's funded. That starts your 56-day covered period. But on payroll costs, you have the ability to begin that covered period on the first day of your first pay period after receiving the funds. So I think there was an example, or we'll just make one up, that if you received your PPP funds on April the 20th, but the first date of your first period was April the 26th, you can shift your covered period for payroll costs, now called an alternative payroll measurement period, to begin April 26th. And then that's going to start 56 days from there. So if you do that, there could be 2 different covered periods in a way. You've got a payroll period, or you've got a covered period for payroll cost, and then one for covered cost. So specifically, that's one I think a lot of people might misinterpret. It only changes it for payroll cost. Have any comments on that, Bill?
Yeah, I think it was designed to maybe make it cleaner and simpler and easier to track, where you just look at, what was actually earned during the pay period, maybe a little bit easier to do it this way. Again, it's almost like you have to run the tape between those two to figure out what gets you the biggest payroll number. And it may shake out to be very similar. I mean, until you run the tape, it's really kind of hard to say, but this certainly for tracking purposes and stuff would probably be easier and cleaner to show, would be to start it on a clean pay period and go from there. Yeah,
you're easily going to be able to show, the lender that where the date that it starts incurring if you switch that period.
That's right. That's right.
Something brand new. I hadn't heard of that before this forgiveness application. So I knew a lot of people were lobbying to kind of get good measurement periods. So it looks like it played out.
You bet.
All right, one more here, and this kind of caught me. I'm going to say it off guard a little bit too, and it's specifically regarding owner's compensation. So if you're an owner that's an employee or self-employed, that comp that you can get is capped. And before, we always knew it was capped at the $100,000 mark, right? And annualized, for that 8-week period, which is $15,384. Basically take the 100 grand divided by 52 times 8. But now they threw this other thing in there. It's the lower of that amount or your annualized 2019 salary. So I'll throw an example in here. Let's just say last year in your business, you paid yourself $60,000. Okay. Well, you can't technically go and just pay yourself during this covered period $15,384, the max, because that would be $100,000 annualized. It's the lower of the two. So you can't really give yourself a raise during this period. They're not going to allow you to do that. So kind of snuck that one in. I hadn't heard that before. And then also about, it's really uncertain on how health insurance and retirement plan benefits play in here for owners. We know on non-owners, the compensation is capped at the $15,384. And there's nothing about 19 on non-owners. But also on non-owners, in addition to the 100K, you can do your health insurance and retirement plan. How we're reading this documentation here, it's really uncertain if all that's capped at the 100K or if it's the same treatment. So a little confusing. What do you think on that, Bill?
Well, I think when you see our case study and we actually pull up the form and kind of show it, you'll see that the owners, general partners, sole proprietors, it's kind of carved out into a different section. And it very clearly calls out this rule here, the 100K. or the 2019 salary, which I agree that one was unexpected. I guess, is kind of common sense, but it could catch some people off guard if they did give themselves raises compared to 2019. But the health insurance and retirement benefits, my understanding was always that we could include those for all employees, including owners, but that's definitely something we're trying to get some guidance on, because that could be a pretty healthy amount for some people.
Yeah. I would assume there's more guidance coming out on that. But again, if you're an owner there, make sure, that you don't, in essence, give yourself a raise. Maybe you already had, but technically you can't give yourself more than what you had last year on an annualized basis.
You won't get, it won't be eligible for forgiveness. That's right.
That's a great point. You could give yourself the amount, but it wouldn't be forgiven. You're right. All right, let's roll on. So we got this salary-based reduction. And we've always talked about this, how in essence, what you pay, your employees during the covered period, you can't reduce that basically by 75%. You can't reduce it 25% or more based on the periods, the quarter before, the first calendar quarter. And so it basically, nothing really changed here too much, Bill, that I really saw from what we've been saying, except they really did provide this safe harbor in here that allows them to kind of minimize that reduction. And we'll kind of hit on that just a little bit. But basically what that allows you to do is, let's just say your business did take a hit and your revenue coming in was way down, and you didn't let some employees go, you just reduced their compensation. Technically, you're not going to get penalized for that if by June 30th, you're able to get their compensation back up to where it was before. There's some dates that they put in here. I mean, they have a February 15th through April 26th date, I think. And so a little calculation, again, we'll go over in the case study. But it does provide that safe harbor to kind of get that wage back up by 6/30. It gets a little confusing. But nothing really surprised me here. And again, it is only pertaining to employees making $100,000 or less. If they're above $100,000, the wage reduction doesn't apply. Anything surprise you there, Bill?
Well, I mean, it rolled out the mechanics of it, which was good. But, I'm a visual learner, and I had to actually get pen to paper and kind of sketch this out to try to make sense of it. That's why we hit it high level here. The case study, we will actually show how it plays out. It's hard to explain because, like you said, there's a lot of different trigger periods that you can look at. I do think the 6/30 date's important, that if you do have a reduction of salary, hopefully your production, your revenue's kicking up and you're able to get those people back. And there's a little safe harbor there, but definitely something that it's complicated. It's not easy. You'll probably need some help on this. But again, we'll go through a detailed example that will show exactly how this works and how the reduction might be calculated.
Yeah, you're right. The case study is going to shed a lot of light on how this all kind of works in conjunction with each other. So coming from the salary and wage reduction, we go into the full-time equivalent reduction. And this really clarified really how you calculate that average FTE. We had a lot of people talking before about they were using the 30 hours is what an FTE is counted at. Yeah. I think that goes from healthcare. But what they came out with here is basically you take your average number of hours worked during the period and you divide it by 40. Okay. And basically, so here's an example. So if you have 30 hours, that's their average hours worked, divided by 40, that employee is a 0.75 FTE. And then you take that calculation and you basically compare it up to one of two periods, February 15th of 19 through 6/30 of 19, or the first 2 months of 2020. And if that number, during that covered period is less, then there's potential for reduction. But I love this one, and maybe just because I like things simple, they kind of said, well, there's also another way you can calculate this simplified method. And that's very easy. It's a lot less math. And that basically says if your your average number of hours worked is 40 or more, that employee is assigned a 1.0. If they work anything less than 40 hours on average, it's a 0.5. And so that's a very simple way to do it. But I think what you're probably going to have to do is to calculate that each way, depending on what kind of business you are. I've talked to some businesses where it could matter how you calculate it. Now it has to be calculated the same way for both periods. You can't do apples here and oranges here, right? It has to be apples to apples. But you're probably going to have to look at those on both calculations to see the biggest benefit. And it is an employee by employee basis. And then again, there's that safe harbor that allows you to basically restore that head count back to where it was at before at that 6/30 date. So both of those safe harbors have that June 30th date. Elaborate on that, Bill. Did anything really stick out to you? I know the 40 surprised me a little bit, but anything there?
This one, actually, I kind of liked it. Even as a visual learner, I could understand what they were saying here. They kept it pretty simple, I thought. This way, each employee it becomes a number, and you add them all up and you compare them back to these other two periods. For a lot of our clients, that have 5, 10, 15, 20 employees, it shouldn't be too bad. Obviously, more employees you get, a little bit more cumbersome, but should be pretty easy, simple calculus here to look through. And again, if you have a little attrition and your head count's low, and you need them, and it makes sense from a business perspective, you have till June 30 to go out and restore that head count to get it to where that number is a good number. So they give you a lot of outs here to try to get you up to where your head count is appropriate and kind of in line with what it was pre-COVID-19.
Yeah. I think it gives good clarity on that, and it's a lot of math work going to go into that. Two different calculations, but that might be the general overview of this form. There's a lot of math going on, so it's you got to make sure you pay attention on what's going on here. Diving into it the last, and they kind of Treasury and SBA hit on this a little bit in some previous FAQs, but a lot of the questions we had from dentists in particular is, hey, I'm reaching back out to my employees and we're going to bring them back. Our business is allowed to open back up, but some people are saying, no, I don't want to come back for, it could be any kind of reason, a multitude of reasons. But it specifically says here that there's an exception to this FTE reduction. If number one, so you make a good faith effort to rehire, which was rejected. That's number one. Or any of your team members who were fired for cause, big word there, voluntarily resigned during the covered period, or voluntarily requested and received a reduction in hours. If any of those pertain, it's not going to penalize you on that FTE reduction. Okay? And the one going back, so if you made that good faith effort, you've got to document that. So if you reached out to employee A and they said, no, I'm not coming back because XYZ, document that you offered them, the date that you offered it to them, what they said, their response, put it in your file, because you'll need that for documentation purposes. Comments on that, Bill?
Yeah, I mean, I think that was a very favorable thing that certainly helped. It does say that you need to fill that position with a new employee to not have that affect the reduction. I think there's probably a little clarity that's needed there just to completely understand how that component of it works. But it certainly does. I mean, this is a situation we've heard and seen a lot. So I think this is a welcome provision that you do have potential to not get dinged on something that was really beyond your control or was a legitimate business decision or personal decision on the employee side.
Right. Yeah. And we're hearing a lot of that from our clients, so this kind of provides clarity on that. So here's one. So And again, this will make more sense. So what I ask in the meantime, but after you watch this video and before you see our next video, probably latter part of next week on the actual case study, look at the forms, because this might be hard to wrap your head around until you look at it. But basically, it kind of clarifies the calculation of ultimate forgiveness is basically the lesser of 3 items, okay? And that is your PPP loan amount. That's number 1. Number 2 is basically your payroll / non-payroll costs that you've spent minus any FTE or salary-based reductions. And then the third one is your total calculated payroll cost divided by 75%. And remember that 75% comes from you are required to spend 75% or more on payroll cost in order to be, for that eligible part to be forgiven. So that's where that comes from. I kind of got confused on this. Bill, we were just talking before we got on the video about this slide, and I'm kind of like, well, I don't understand. So then I kind of had to go to the form, walk myself through it, talk about it a little bit, and I understand it. So this might not make ultimate sense now, but the forms will definitely, I think, make sense once you see those. So anything there you see, Bill, that?
It is confusing. I mean, it really wasn't what I expected how it to flow, but I think, the forms will help clarify it. But, the first one, PPP loan, I mean, obviously you're not going to have anything forgiven above that. There may have been some talk at one point about some accrued interest being forgiven. Doesn't sound like that's on the table. So the second one's kind of what everybody was thinking this was, as you take your payroll costs, all the good stuff that you spent during the covered period that we've all talked about, the payroll, the utilities, interest, all that stuff. And then you back out any of these reductions that we just covered, these last 2 slides, a reduction in FTE headcount or a reduction of greater than 25% of salary. And you take those numbers, you net them down, and that's kind of where we all thought we were. But what they've done now is they've clarified that if you really were top heavy with other non-payroll costs and it skewed your results to where you're not at the 75%, then what they're going to do is they're going to say, okay, well, the most you can get forgiven is 75% of the payroll costs incurred. So we're going to take that number that you calculated, divide by 0.75. And if when you look at the total between that and the other one, if it's less than 75%, you can pretty much rest assured that your forgiveness amount is going to be reduced even more based upon that calculation. Again, without seeing it, it's really hard to visualize. We'll try to build out the case study where you can kind of see it in play. But it's something that, again, if you're not able to hit those payroll numbers, it could be a little bit less forgiven than we were hoping, pending some comments we have on the next slide.
Yeah. Yeah. And you might be scratching your head thinking, well, oh boy, how's this affect me? How's this last part affect me? Well, I think it's safe to say, Bill, that the third point here probably doesn't affect you, or actually won't affect you, if you spend at least 75% or more on payroll costs.
Yeah.
It's right. Where you spend a little less that it does kind of skew that calculation. It's not just as cut and dry as what we had hoped. But again, the case study is going to provide clarity on how exactly the mechanics of it work. Okay, so documentation. So just documentation and some additional observations. Basically, there's a whole page, I think, in here. I think it is a whole page on documents, basically, they're musts, documents that you must provide to the lender. And there's a whole other section at the bottom of basically documents the borrower is required to keep themselves, but not ultimately has to give them to the lender. So there's a lot of documentation, as you can imagine, around SBA loans. But basically the whole thing is have a clean file, work with your advisor, work with whomever to help get this filled out. First off, fill it out as accurately as you can and make sure it's good, and then provide it to the lender, because the lender's going to sign off and make it easy as possible. We've been talking about that since day one, Bill.
Yeah, I think, you look at when we first did the applications, we were helping clients, our goal was to almost put together like an audit type file that has everything boom sequentially and just really clean, so your banker can look at it. we're hearing that a lot of bankers are probably going to have an automated process. There's going to be a cottage industry that comes up, of Jack Henry and these other banking type software providers who will probably set it up where it will be able to be done through an automated system, which will be kind of nice. But you still want to have your file locked and loaded and ready to go. So if your banker asks, it's basically check, 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 looks good. I mean, it's as simple as that. Right now, we do not anticipate, unless you have a very large loan, that you'll get much scrutiny on these things, which, by the way, we didn't put on here, but there is a checkbox that says, did you receive or your affiliates receive a loan in excess of $2 million? Do not mark that. If you do not receive them in excess, that is a automatic ticket to an audit. They did say anything over $2 million, the SBA is going to audit. What that looks like, who knows, but probably not something you want to mess with. So just as an aside, be sure when you're checking that box that you do not check that you received over $2 million. But again, have a clean file, have your records locked and loaded, ready to go. Keep it simple. Allow your bank to be able to check the boxes and get you approved.
Yeah, that's exactly right. The $2 million is big. Most of our clients were $2 million or less. So do not check that box if it's below $2 million.
Right.
Dollars. And then a couple other things. Maybe we've got our fingers crossed, and you see a lot on the news. You hear a lot from what people are lobbying Congress and Treasury, SBA to do. But forthcoming, there's potential, maybe flexibility in the 75% use of the funds for payroll. A lot of businesses still aren't open, and how are they going to spend 75% on payroll if their people are still laid off and their covered period's coming to an end? So hopefully we see some flexibility on that. Kind of the same premise there. If you're still closed, how are you going to spend all the money in the 8-week period? Maybe you received the funds 6 weeks ago and you're still not open. How are you going to spend it in 2 weeks if you open today? So hopefully they extend that 8-week period. We've heard 16 weeks. We've heard more than that. So keep your fingers crossed if you need that to apply to you. And hopefully something's done on that. And then the big one, the tax deduction of expenses paid. We've kind of talked about this, in the interim final rule, I think the language said that it was it's forgiveness of debt, but I'm going to use the word tax-free. It's not a taxable forgiveness of debt, but the code, said that the expenses that you paid attributed to that tax-free money, if you will, is not deductible. So same thing. So anyway, there's lobbying going on to try to get that changed. Again, I'm keeping my fingers crossed. I got high hopes. Those are 3 big ones. You got any other big ones, Bill, or comments on those 3?
Well, I mean, I think the 75% is interesting, as we will see next week, and as we discussed, that has the potential to limit your forgiveness. And there's certain businesses that may be more capital intensive. They may not have that kind of 70, that kind of ability to hit that, or they may be closed down, a restaurant or dentist office, and it just didn't make sense, or people weren't willing to come back. So, that would be a welcome change if they change that number down and maybe give us a little more leeway there. I think probably for most of our clients, the more impactful one would be potentially changing that 8-week period. Right now, a lot of our people are over halfway through that time period. And that's one of the frustrating things about the whole PPP process is that we're getting guidance, in the 4th inning, or 5th inning. I mean, we're halfway through the game, and now we're trying to figure out how we're going to score some runs here. So, that's something that would be a welcome relief. Some people already have kind of made their business decisions and would love to have known this a while back, and they really don't have much recourse. But, if we could get a little guidance quickly that says, hey, that 8-week is now 16, that's going to be welcome news for a lot of these dentists who are just now opening shops, and other businesses who are just starting to get back into customer interaction and patient interaction and bringing their people back. Tax deductions, I kind of get that a little bit. I mean, that's kind of been buried in tax law for a while, that, if you earn or have an expense that's tied to a tax exempt income, that it's not deduction. So that would require probably a Congress to amend tax code on that. So we'll see. That would be added bonus that would be like, being able to double dip basically, tax-free money and a deduction. So we'll see. That would be great.
There's always hope, Bill. There's always hope.
There's always hope. If we could do that, that would really help a lot of people, because the thought process there is that they may not have had those expenses at all if they hadn't have done that. So we'll see. We'll see on that one. I think Congress is trying to push for that. I think Congress is pushing for all those, to be honest. So we'll see if we can get a deal done and get Treasury and SBA all on the same page and try to get those three hammered out.
Yeah. Well, guys, good. That's good stuff, Bill. I mean, this, again, guys, we just wanted to hit very high level. Kind of after reading through it multiple times, reading other articles, we thought we'd just present the high points, the key updates, the things we didn't see coming, the things that provided clarity for us. So I hope you see some value in this. Again, what I would do from here, go pull down the application. Go to treasury.gov, click on the COVID-19 at the top. It's about halfway down. The loan forgiveness application for borrowers. Look through it. We're going to get on here next week. We're going to share up we're going to take that application. We're going to throw it into Excel. We're going to go through, do a case study. And I think a lot more of this is going to make sense once you see it all together, because this application is basically, they're like worksheets that build on each other.
Yeah.
So you start out here with data that transfers to this one, that transfers to this one. You really have to understand how they work in order to fill it out yourself. So hopefully we can provide some clarity and some instruction for you on that. We don't have all the answers, but we try to find the answers to give them to you. Any parting comments, Bill, you got on this application?
So I agree with you. I think you started out the conversation well, guys. We're nearing the end of the finish line. The PPP has kind of consumed our lives. I'm sure yours too. I think we're all kind of ready to put this to bed. Hopefully the case study will be really impactful, that will allow you to really start putting pen to paper under the laws that we have. And maybe by that point, we'll have better guidance too on some of these things that we mentioned that we're hoping are clarified. But in the meantime, study up, try to understand the forums, reach out to us if you have any questions, talk to your CPA. They're probably going to have to be involved in this. This is not going to be an easy calculation. I mean, we're anticipating it's going to take some time to do when we work with our clients on it, and having good information, on payroll data and stuff like that. It's going to be important. So just be prepared, and let's get our file tight, and let's try to get as much of it forgiven as we can.
Yeah, you make a great point. I probably wouldn't recommend a business owner to do this themselves, and they're pretty sophisticated and understand it. It doesn't hurt to ask for help. It's a big deal. Getting this loan forgiven is a huge deal and a big impact on your business. So reach out for help. If you have questions for us, comment on the video. We'll get back as quick as we can. If we don't have an answer, we'll tell you, and we'll go find somebody that does. So guys, we appreciate your time. Chime in next week, and we're going to dive into this, and hopefully we can help you guys out. Bill, appreciate it. We'll talk soon.
Yeah. Thank you.
All right, we'll see you.
Take care.